Good afternoon, everyone. I hope you're all doing well, and thank you for joining us today. My name's Garrett Lambert, and I'm joined by our speaker, John Harrington. Today, John will summarize 530A accounts and some planning strategies to consider with these accounts. Before we get started, we wanted to go over a couple of housekeeping items. First off, this webinar is recorded, and the recording will be posted to our website within a week from today. And secondly, if you have any questions as we go along, you can drop them in the chat or in the Q&A. You can, as always, nothing you hear today should be considered tax, financial, or investment advice. If you have any questions around how these accounts may relate to your specific situation, please reach out to your advisor or another member of our team. These accounts were originally introduced in the One Big Beautiful Bill Act in July of 2025. John, can you go ahead and give us an overview of the accounts and how they work?
I will, Garrett. Thank you very much. Yeah, these are relatively new. They could started to be opened on the 2025 tax return, and they're officially able to be activated on July 4th of this year. So it took about a year for what are known as 530A accounts, or also Trump accounts, to be go from the One Big Beautiful Bill, which you mentioned, to reality. So today we're going to be talking about all the different parts of these accounts and the complication of these accounts, because they are fairly complicated, especially if you live in one of the seven or so states that aren't following the federal tax rules for these accounts. But really, these types, these TAs or 530A accounts are really not going to be something many people will be using unless they have really realized all their other financial planning goals and max funded all the other accounts that we have able to be taken advantage of, like 529 plans, your own parents' retirement accounts, UTMAs, things of that nature, which we'll get into later. The one exception is if your child is eligible for the free $1,000 that is part of this pilot program for children that are born from 2025 or to 2028, or if your employer is making contributions for children, dependents of employees, then potentially that would be another reason to use these. But despite that fact that I don't think many people will be using these, we are still going to discuss them today and talk about everything that relates to them. All right. Eligibility requirements. They're not that difficult. If you are under age 18, you can have an account established for you as long as you have a social security number. People are only going to be allowed to have one 530A account. So it's set up by a person that we're going to discuss who's able to set these up for children in a little bit, but there's only one can be set up at a time. And for the pilot program that I mentioned a few seconds ago, that is for children born between those two dates, 2025 and 2028, and they're eligible for that $3,000 seed contribution, which is considered the pilot program. So pretty easy to understand who's eligible for these. The timeline is basically divided into two periods. You have the growth period, which is basically when the account is opened to the start of the year the beneficiary child turns 18. During this period is when you make contributions. The contributions are invested, they grow, and it's all really focused on the beneficiary at that time. Once the child turns 18, then the count freezes, and or once you get to the year that the child turns 18, the account freezes. You can't put any more contributions in. You can't take distributions. You can't change investment options until the child turns 18. So there could be up to 364 days if the child's born on December 31st, where the account's frozen. But after that point, it goes into the post-growth period, and that's where it becomes more or less an IRA. We'll talk about what options are available to children once they turn 18. There's four of them, but at that point, the beneficiary essentially becomes the account owner. Who can open a 530A account for a beneficiary? So there's a hierarchy of who can do it. Starts with the guardian, if that's not a parent, then it goes to parents, then adult siblings, grandparents in that order. And it really has to do with who is in charge of the beneficiary. Uh, and again, only one account can be open at a time for a given beneficiary. So if you have two parents, only one of those parents can open up a TA for the beneficiary. Want to make sure that's clear because you don't want to get into any issues with having multiple accounts open if you decide to use this strategy or these accounts. Opening a 530 account is fairly simple. There's three ways to do it. You can go to the TA Trump account mobile app, which can be downloaded on Android and Apple phones. You can go to the trumpaccount.com website and do it, or you can um, go to irs.gov through a already existing IRS account that you is basically you could already have one if you're making estimated tax payments or you have a um, e-pin that you use for your tax return because you have to file a form 4547, which you could have done with the 2025 tax return, or you can do it with the 2026 tax return. But by far, the easiest way to do this is either use the mobile app or go to trumpaccount.com to open the account. That allows you to file the form 4547 much easier than doing it with your tax return or by going to your account on irs.gov. Once you submit the account opening application and the 4547, you will get an email that will indicate the account is ready to be activated. And at that point, you go on to trumpaccount.com, not trumpaccounts.gov, which is a completely different website, and you activate the account. On the next slide, we have a screenshot of what that looks like. Once you've activated it, you can go in there, make contributions, and select investments. Right now, there's only one investment that you can select. We're going to talk about that a little bit later, but that's a that's basically the one, two, three of how to set it up. It's very easy. I've done it myself for my own children and to test it out, and it's very intuitive, easy to do. Again, the website they prefer that you use the mobile app, but if you want to use the website to access your children's 530A accounts, you have to go to trumpaccount.com, not trumpaccounts.gov, which looks basically exactly like trumpaccount.com, but it's more of the promotion site. When the One Big Beautiful Bill announced these, they set up trumpaccounts.gov to promote Trump accounts to people who might be eligible for the pilot program, and that site still lives. That is a screenshot of what you will receive in your email to activate the account. You click on that, it will bring you to either the mobile app if you have that downloaded on your phone, or it will take you to the Trump account website. Once you get in there, and I'll note that Robinhood is currently the only custodian that is offering Trump accounts. 530A account. So if you want to set it up, you have a TA for one of your children, you have to go through this one site. And that will be the same going forward. The first account TA that is set up has to be done through Robinhood at trumpaccount.com or through the mobile app. Eventually, you'll be able to transfer that to another custodian if you choose, not currently an option, but in the future, you would be able to do that. Some other things to note, you can appoint a trusted contact, which is if TA trumpaccounts.com can't get a hold of you, the trusted contact is someone they can reach out to, but there is no beneficiary designation on these accounts, nor can you put a secondary authorized individual. So it's not like with a 529 plan. If you're an account owner of a 529 plan and you die, there's usually a secondary person that will be the controller of that account. The Trump accounts do not have that as an option. I don't know why they should, uh, but that's not the case right now. Currently, there's only one investment option, and it's in an S&P 500 ETF. Eventually, there's going to be a few more options at the Robinhood custodian. It We'll see if Vanguard and Fidelity and Schwab and other custodians have uh, a wider range of investment options. But from what we're hearing right now, S&P 500 and total market ETFs and mutual funds are the only options. I've listed out what funds are coming soon, and it's really only total stock market and S&P 500. So not a lot of options for diversification purposes, but um, as I'll talk about later, the law sort of tied the hands of how these accounts could be invested, and there's not a lot of options. So, all right, who can contribute? This is interesting. There's three different ways for contributions to be made to a TA, and the first is the most obvious is direct contributions. These are considered coming from parent, grandparent, really anyone can make them, including the beneficiary. And that those are limited to $5,000 per year from all those sources. So if you have one parent giving 2,500 to one of these accounts, a step parent giving 2,000, then everyone else can only make another $500 because that maximum amount can only be 5,000. And because you can only have one TA, the custodian should be able to keep track of the contributions that are made during the year, so you're not over contributing to it. I say should be able to. Hopefully that is the case. Like if someone tries to put more than $5,000, there'll be some sort of error message that won't allow them to do that. And one other thing to note is that for all of these contribution types, they all have to be made by December 31st of the contribution year. That's unlike IRAs, for instance, and HSAs, where you can contribute up to the tax filing deadline. These have to be made by December 31st. So going back to direct contributions, $5,000 a year, index for inflation starting in 2028. These count as basis in the account. We're going to get into the tax consequences of these accounts later, but these count as basis. They're coming from individuals and they are not tax deductible. All right, moving on to employer contributions. So employers can make up to $2,500 per year per employer or dependent in contributions to a 530A account. It's tax free. That contribution is tax free to the employee federally, but some states are treating them as income. And if you're in one of those states, which again we'll get to later, that might be a complication that makes it so it's not worth having one of these accounts for one of your dependents. Employer contributions do count towards the $5,000 annual limit. So if your employer is contributing for your dependent, then you have to factor that into the equation. Um, these are indexed for inflation starting in 2028, just like direct contributions. And this is sort of complicated, but if you're a sole proprietor or single member LLC, you can't get a because of the way that the rules are written for these, you can't get a deduction for making a contribution. So if you wanted to make one for your child, it's not going to work because of the rules with these non-highly compensated employees. I personally don't know why any employer would want to make a contribution to a Trump account for one of their employees or dependents. When you look at like a list of all the benefits that you could give to an employee, why would you want to give like a contribution for a child's retirement? Doesn't make sense to me. Although a lot of a handful, I would say, of employers lined up to match the pilot program amounts shortly after that pilot program was announced. So they're going to match the $1,000 for their employees' dependents. Not a huge amount of money there because there's not a lot of babies that are being born in that time period in terms of like working for a single employee. So it's not like employer, I mean, it's not like this is offered to all their employees. So a little bit of a low risk, but I can't see an employer saying, hey, I'm going to just make this as a general benefit for my employees. The other type of contribution is charity and government. So there's no limit for these types of contributions, and it does not count towards the $5,000 limit for direct and employer contributions. An example of this is the $1,000 uh, the pilot program that is sort of part of the One Big Beautiful Bill that's from the federal government. If and another example is the Dell Foundation made $250 available for a TA for all children that are living in cities that are under a certain median adjusted gross income. In order to qualify for this type of program, the contribution has to apply to a broad specific group, such as kids under 10 in New Hampshire with active 530 accounts. Because in order to get a charitable or government contribution, you have to go through the process of setting up a TA account. It's not like it's just going to get set up for you, even if you are eligible. So those are the three types of contributions. Again, direct's pretty straightforward. Employer contributions, I really don't see why these would catch on as a contribution type. And I do see how certain, like state governments might be interested in allocating money to children that, live in certain towns. With median incomes below certain levels. I think that, or foster children is another one that seems to be catching on. I mean, that makes sense. So I think we'll see more instances of charity and government contributions than employer contributions. All right, I got into this a little bit before, but how can the money be invested? Pretty straightforward, and it's similar to the thrift savings plan, which is the defined contribution plan slash 401k for all government employees and members of the military. It's very simple, and it's in this case, it's even more simpler than the thrift savings plan, but it has to be in low cost mutual funds and ETFs that have an expense ratio below 0.10%. The one that exists now is 0.02%, the S&P 500 I mentioned earlier. So almost free. It has to track a broad US equity index, large cap, small cap, mid cap, all cap. Um, but it can't be international or emerging markets. So that's different than most target date retirement funds where you have a mix of international and US equity. This is strictly US stocks, and that really limits the options. So if you do sign up for one of these accounts, you're not going to see a lot of investment options, which makes it easy for people, I think. Um, and it's unclear how fund allocation will work if using multiple funds. Right now, like as I mentioned, there's only one fund that's uh, existing right now. When two are available or more than two, I'm not sure how they're going to handle rebalancing, moving from one fund to another. Time will tell to see how that's going to work. What the investment options can't be, there's no sector fund, so it can't be like a biotech US equity fund. There's no leverage or inverse funds, which is like funds that take on debt to invest in more equity. Like they're designed for to be simple, so people understand it. Um, and these rules only apply if it stays in the 530A account. Once you turn 18 or your child turns 18 and they roll it to an IRA, then it's everything IRAs can invest in. So this is really during that first 18 years. All right, 538 transfers. So as I mentioned, currently Robinhood's the only manager and custodian of all the new 538 accounts. Fidelity, Vanguard, and Schwab have all made announcements that as soon as they're able to, they're going to allow people to open up 538 accounts. And then the expectation is that once you can open one at Fidelity, Schwab, or Vanguard, then you'll be able to transfer the Robinhood one to that custodian, or it's all one process because again, you can only have one open at a time. But how that's going to work, we're not sure yet because Robinhood's the only game in town right now. We've been asked if advisors are going to be able to manage these. Not likely, um, primarily because they're going to be offered on the retail side of these custodians, and they're very strict on how they can be managed. So I don't see that as being something that's able to be done. All right, so what happens at age 18? So you have set up one of these accounts for your child. You're contributing to it as they get older. They turn 18, or it turns into the year that they turn 18. At that point, the account is frozen until their 18th birthday. So my birthday is March 29th. If I had set one of these up for myself, I turn 18 4 months into the year, 3 months into the year, between January 1st and March 29th. I can't really do anything with that account, but at the time March 29th comes around, I have four options. One is I can take a distribution, take money out of the account because now it's mine. There is a penalty associated with that, but it's an option. You might be able to keep it as a 530A account. Right now, we're not sure if that's going to be a real option, but it might be. Robinhood is automatically converting the TA to a IRA when the person turns 18, but some of these other custodians may decide to allow people to keep it as a TA. Probably the least likely selection for anyone, but it might be an option. Next is you roll it to a traditional IRA. That seems like a really logical place for people to, option for people to choose. And then the fourth option is you convert it to a Roth IRA once it's in the traditional IRA, but you go one step further and make that conversion. We'll talk about why that is is a benefit that most beneficiaries of these accounts should do if it's possible. because these are meant for retirement, and traditional IRAs are taxable when you take distributions after turning 59 and a half. If you can get into a Roth, it will grow tax free. And then when you take a distribution, it's not subject to tax. So that's the best course of action. All right, we'll go through each of these specifically. Only reason to keep it as a 538 Trump account is to preserve backdoor Roth contribution. So if you're earning money after you turn 18, you exceed the Roth contribution AGI limit, you can do something called a backdoor Roth contribution. You make a non-deductible contribution to a traditional IRA and then convert it to a Roth. If you have other IRAs, this really isn't possible, or it's too complicated to do it. So if you move a huge 530A account to an IRA, all of a sudden you really can't do any backdoor Roth contributions unless you convert the entire TA balance after rolling it over. So again, very limited circumstance where this would make sense to keep it as a 530A. I don't think we'll see a lot of people doing this. And the custodians may force it to be converted to an IRA at that point anyway. Number two, you just roll it over to an IRA, and that should be able to be done with any custodian that currently offers IRAs. One thing to note here is with respect to basis. So as I mentioned before, direct contributions are being counted as basis, which means if you leave it in an IRA, traditional IRA, and it grows at retirement, you start taking distributions, or even before then, be subject to penalty, but you could still do it. You take out a distribution, the basis is not taxable. Whatever basis you've built up, it's only the earnings that are taxable. Or if you get a employer contribution or a gift, those are not counted as basis, so distributions of those would be taxable. And this would be the same if as I mentioned, if you converted it to a Roth or took it out uh, from an IRA at retirement or took it pre-retirement, it's still the basis rules are the same. If you decide now, again, these are meant for retirement, and the hope is that any contributions that are going into these TAs are just being left there, and the investment growth over time becomes this huge amount for someone's retirement. But at age 18, the beneficiary child could decide to take distributions from the account. And if they do that pre 59 and a half, then there's going to be not only tax associated with the earnings that come out, eh, there's also going to be a penalty. And that is the calculation you have to do when you take a distribution to determine how much of that distribution is considered basis and how much is earnings. That is on a pro rata basis, and only the earnings are subject to the tax and penalty, but you have to do the calculation. So we have an example here. You make 10,000 in direct after-tax contributions. That increases the basis. You get the $1,000 from the pilot program. You have $5,000 in investment growth. The account value is $16,000. If you take a $1,000 distribution from a TA, in this circumstance, $625 of that is basis and 375 is attributable to the seed money and the investment account. And that would be considered taxable. And also it would be subject to penalty if it came out before 59 and a half. Now, there are a list of exceptions that apply to all IRAs where it's not subject to penalty. We put them up there on the screen. This is not the full list, but these are some common examples, which might help someone avoid that 10% penalty if they needed to take a distribution. All right, the last thing is converting to a Roth IRA. This would be the step that would have to happen after you took the money from the TA and moved it to a traditional IRA. I don't think you're going to be able to go direct from the TA to a Roth. Might be able to, but I don't think that will happen. I think you'll have to go to traditional and then traditional to Roth. But you could do that fairly quickly. As I mentioned before, this is where the tax planning and retirement account um, accumulation in value is for children. If you can get this money into a Roth IRA shortly after they turn 18, or the kiddie tax rules might want you to extend that until they get out of college, but when they're able to convert it, 18 to 24 at some point, then they have 40 years of tax-free growth and it comes out tax-free at retirement. This slide right here is where the real opportunity is. And we're going to talk more about the kiddie tax in a later slide, but just remember, if you open a TA for your beneficiary, you should be thinking, how and when am I going to convert this to a Roth IRA? And if you have an advisor, they should be helping you think through that process. We have up on the slide, ensure tax can be paid from outside the IRA assets. You don't want to take a distribution to pay the tax. You want to hopefully have some money set aside to pay the tax, which is going to be minimal, hopefully for the beneficiary, depending on because you're going to have basis that's not taxable. It's really just the earnings, and it's going to be at a low tax rate for the beneficiary because probably they're not in a high tax rate right after high school or college. So the tax should be minimal, but better to pay it from existing cash than taking a distribution to cover it. In terms of where these accounts rank in financial and goal planning, they're, in my opinion, they're at the end of the list. So when you're a parent, you're thinking about, should I be opening one of these 530A accounts for my child? You need to be thinking through these other options first. The one exception to that is your employer giving you free money for your dependent, or is your dependent child eligible for the $1,000 pilot program? If in that case, you will want to set up the 530 account. But if they're not eligible for that, there are other options available to them that you should be thinking about. The first is, have you funded your own retirement accounts? Because if you haven't funded your own retirement accounts to the maximum amount that they can be, why are you thinking about funding your children's retirement accounts? I just those are too restrictive. If you're putting the money for your child away and you just can't get that out of there for yourself if you need it for your own retirement. If you're thinking child's going to college, I have a college goal for them, I want to save for college. Again, these are not the accounts to do that. A 529 plan is a much better option. Then it's child Roth IRAs. If they're working, they can make contributions to that. And we'll talk about that in a second. And then finally, a custodial brokerage, otherwise known as UGMA, those can be a better option than a 530A account. There's more flexibility with those. So let's talk about these a little bit more specifically. As I mentioned, for a college savings goal, the 529 plan is the best. Investment earnings are not subject to ordinary income tax. You are not paying tax when you take a distribution from a 529 plan. If you're using it for qualified education expenses, you can put a lot more money into these per year, up to five times the annual gift exclusion, which is currently $19,000. So you could put almost up to 200,000 into a 529 plan for both you and your spouse if you wanted to. And now you can roll up to 35,000 per beneficiary per beneficiary into a Roth IRA if they don't use the 529 plan money for education expenses. So that is an easier way, in my opinion, to get money into a Roth IRA because it's the tax rules for that 35,000 are easier in the 529 plan than they are in a TA or 530A account because you don't have to worry about, first of all, you get more investment options in 529 plans. You don't have to worry about setting up another traditional IRA and then rolling it over to a Roth. There's no tax on rolling it over to the Roth, so that 35,000 is better off going from a 529 plan. Custodial Roth. So right now, once your child starts earning income, you could contribute to a Roth IRA for that child. And it's a custodial Roth until they turn the age of majority, age 18. Right now, there's a $7,500 annual contribution limit. That is a much better if they have earnings, put it into a custodial Roth IRA instead of a Trump account. You're bypassing a lot of hoops, and you're getting exactly where you want it to go, which is into a Roth IRA. So, uh, whenever your child starts working, that should be what you're doing first, maxing out the contribution to a Roth IRA. If they're not working, you've already maxed the 529 plan. Well, then you might want to think about an UTMA or an UGMA. This is essentially just a brokerage account that's set up for a minor, and it can be invested in really anything. If you're taking a distribution from it, it's not subject to any penalties. You just have to sell the asset and then pay tax on any capital gains, but there's no 10% penalty. It's not subject to ordinary income. If you need it, it can be used for anything. Like all the other accounts, the child gets control at the age of majority, but you're investing this for your child. The one wrinkle with these is that they're subject to current taxation, the dividend, interest, capital gains, et cetera, subject to annual taxation and the kiddie tax, which I'm going to talk about a little bit later. So that's really only the complication, but it can be a benefit if you're harvesting those capital gains annually to increase the basis so that once the child gets control of this account, they may have a minimal capital gain. Uh, if they needed to sell it for some purpose, like buying a house or opening a business or whatever. All right, so now we're gonna hop into talking about the tax considerations with these accounts. When you make a contribution to the account, you're not getting any type of favorable tax treatment. So there's no deduction on your tax return and really no benefit to you. If you get it from the pilot program and employer charitable contributions, that's not counted as income to you. It might be on a state level, but from a federal level, it's not counted as income. The difference between these two is one adds the basis and one does not. And that basis, as I've talked about before, makes a difference when you take distributions or do a Roth conversion. The good thing is the account custodian is going to have to keep track of that basis and send it to you annually on this 5498 TA. So that's perfect, but that only goes up to the time that they get out of that TA, so age 18. And once they're out of the TA, you have to keep track of the basis from that point forward. And that's why I would say the last time you get one of these, you really want to keep the record of that because if you do a future Roth conversion or you take money out of it for any purpose before retirement, or you wait to retirement and leave it in a traditional IRA, you are going to need to know what that basis is because that will come out tax free. On a federal level, the growth in the accounts, whether that be capital gains, dividends, interest, et cetera, there's no tax on that. When you take a distribution from a TA, the standard IRA rules apply, so that's subject to ordinary income tax. And if it's before 59 and a half, as we've already talked about, it's subject to an early withdrawal penalty unless one of those exceptions apply. So this is a little complicated on the front end because of that whole basis thing, but it acts like an IRA during the growth period and distribution period. But again, you have to keep track of the basis. All right, state tax contributions. If you live in one of these seven states, I would seriously consider thinking twice about opening one of these accounts because they're not following the federal tax rules for how these are being taxed. And then you basically have to keep two sets of tax books, and that's really complicated. So unless your child is close to turning 18 and you want to get a couple of years of contributions in there and then let them convert that to a Roth, if you live in any of these states, because they're going to potentially going to be treating the pilot, not the pilot program, but charitable contributions and employer contributions as income to the child, which would then require the child to file a tax return. And that's a complication. They may tax investment earnings. So if you're getting capital gain distributions or dividends from any of the funds that it's invested in, and that has to be um, taxed annually, you have to file a state tax return. That's complicated. And what about if you want to rebalance the funds that are within the account and you get a capital gain from rebalancing? Is that going to be subject to state taxation? It's There's more to come on this as these individual states put out more clearer guidance on how they're going to approach it. But these states have already indicated they will not be following the federal rules related to these. So again, I would think twice about setting an account up for your child if you live in one of these states. All right. The kiddie tax and Roth conversion timing. So the kiddie tax applies to unearned income for children that are under age 19 or 24, under age 24 if they're still a full-time student. And it's important in circumstances where that unearned income is above a threshold that changes annually, but is now currently $2,700 because the income above that rate is taxed at the parent's highest marginal tax rate. So if you're in a situation where you're taking a distribution from one of these accounts after the child turns 18, but when they're still subject to the kiddie tax, or you're doing a Roth conversion during that time period. And because Roth conversions would count towards this kiddie tax calculation, you want to make sure that you're not doing it in to the degree that um, it it triggers the kiddie tax for your particular situation, um, because it could be a tax bomb that you're not ready for. The best way to do it is to wait until the kiddie tax doesn't apply if you're going to take a distribution or do a Roth conversion, and then do it at that point. So whatever tax year that ends up happening to be, do the Roth conversion in that year. And if you do the a tax plan and say, okay, the conversion is only going to subject that federal income tax at 10% or 12%, the whole conversion, then that would make sense. Even with like the child's earned income over that time period, then it would make sense to do it in 1 year. But if it starts creeping up into a higher tax bracket, it may make sense to spread it over the course of a couple of years. And as I mentioned before, it makes a lot of sense to have money set aside for you to pay the conversion tax instead of having that money have to come out of the conversion itself. And obviously, the sooner the money gets into the Roth, the longer there is to compound. So don't lose sight of the fact that the beneficiary has this existing TA or a traditional IRA, because it's only going to be building the tax bomb when you actually do the conversion or start taking it out as a, if you just were to leave it, which wouldn't be a good idea, you're going to have to take it out as ordinary income once you hit retirement. So sooner the better. There was a question about whether or not gifts or contributions to the 530A accounts would qualify as a present interest gift, and whether a gift tax return would have to be filed whenever contributions were made to these. That would have been a insane thing if that came to pass, because 99% of America have no clue how to file a gift tax return. 99.9% of America. And thankfully, the IRS came out with Rev Procedure 2026-25, establishing that the contributions to these accounts will not make it necessary to file a gift tax return. So thank God for that. So getting the most out of these types of accounts, what you should do is make sure that you're funding all the other accounts we talked about first. Your own retirement accounts, 529 plans, Roth IRAs if they're working, maybe UGMA custodial brokerage account. And then if those are getting max funded, then you can start to think about whether or not you want to start putting contributions into the 530 account, in my opinion. If you're eligible for the pilot program or some other charitable or employer contribution, then it makes sense for you to open one of these. Once the child turns 18 and you can convert the balance to a Roth IRA, as I've said, do that as possible, as soon as possible. And again, plan for who's going to pay the tax on that conversion. You also want to talk to your children about the fact that these accounts exist, because you could potentially put up to $200,000 into one of these accounts if you're contributing $5,000 a year times 18 years. That could get you close, plus the earnings. It's probably be above $200,000, hopefully. You need to talk to your child about the fact that this account will just be theirs when they reach 18 and what they should be doing with it. Even if you walk them through the whole process of, okay, it's in a Trump account, we're moving it to a traditional IRA. This is how you do that. Now we're going to convert it to the Roth IRA. I've, you're going to pay the, or I'm going to pay the tax on it. So you don't have to even worry about that. It's still $200,000 that you have created this account for it to be this huge windfall for them in retirement. But they may not see it that way. They may see it as, you know what, I'm going to take that money out because housing is expensive and I'm never going to be able to buy a house without it. If you're not on the same page with how that money is being utilized eventually, it's not going to work, because you're giving away, your child could give away this huge retirement planning windfall. So you really have to communicate the purpose of why you contributed to the Trump account for the child and what that child should do with it. It's critically important that you track basis, and you have to do that once the account ceases to be a 530A account and becomes an IRA. As I said, hang on to the last 5498 TA. If you're doing one and you live in Massachusetts or California, those other states, you're going to have a spreadsheet and track all of the different, the basis for the state versus the basis for the federal government, because it's going to be different. And when you're filing that tax return, when you do the Roth conversion, you're going to need to know that there's a difference between the federal and state, because Otherwise, you're going to be paying too much tax. Final point here is that the rules related to these are going to change. I mean, it's clear that as people are using these, and 6 million accounts have been opened. So people are using them, and I doubt that these are just going to, some future Congress is going to say, we don't like Trump accounts because they're associated with this president. We're just going to completely get rid of them. They might change the name of them to people just calling them 530A accounts, but I don't see these going away. It would be nice if they said, we're not going to treat these as traditional IRAs. We're just going to treat them as Roth IRAs. That would simplify a lot of the complication of these, and that will be up to a future Congress to decide if they end up doing that. But there's certainly going to be change in these accounts in the future, and something that we'll be obviously monitoring because you know it, hopefully they're going to get better. They're a little rough right now, but that's because they're new and they didn't have a long time to implement. A year sounds like a lot, but on a scale of 6 million accounts and something that's really they had from January 1st to roll these out, and I think it was a pretty good job on the rollout, but it's still changing, and we'll keep up on that. So that's sort of my conclusion, Garrett. I'll open the floor to questions now, if anyone has any.
There were a handful that came in throughout it. You
You didn't cut
answered
me off and ask
you
any.
I knew you were going to answer some of them as you went on, so
Okay.
I let you do that. But there are a few outstanding. Does the account go through probate if the beneficiary passes away?
That's a great question that we did have a slide for in here. I hid it because I didn't think anyone would want to think about a beneficiary dying. But yes, it it becomes an asset of the estate and would be technically subject to estate tax. Obviously, I don't see any of these exceeding the $15 million exclusion for one person, but um, on the state level, it could trigger it. It will be income to the beneficiary on their last tax return. So there would have to be a tax return filed because it's basically going to be a total distribution from the Trump account in that final year, and the earnings or non-direct contributions would be subject to income tax.
That
And
makes
then
sense.
it would be a asset of the state of the beneficiary. Most children don't have wills, so it would go to whatever the state's ordering laws are, and that is 99% of the time would be the parents who would get the after tax amount.
Perfect. That makes sense. Is there a limit on billionaire contributions?
The billionaire contributions, the Dell Foundation, Michael Dell is the only one to do it so far. And as I mentioned before, it was 250. I forget what the total amount was, but individually it's $250 per beneficiary, and you have to live in a zip code where the median family income is below a certain level. I think which was 150,000. And there's a website you can go to check if you're eligible for the Dell family contribution. I don't know how accurate it is. Personally, my town, I live in Newmarket, is New Hampshire, is eligible for it, and my kids did not get the 250 yet. So I don't know how it mechanically is working. It's supposed to just show up in an account if you have one existing, but uh, I don't know how that works. There is no limit. To answer the question in a roundabout way, there is no limit. So anybody can give as much money away into these. You just can't discriminate. So you can't say, I'm going to give it to everyone that lives on Emery Lane in Stratham, New Hampshire. It has to be like a broadly, diversified group of potential recipients.
Perfect. One last one. It's somewhat unrelated, but does the child get control of a Roth IRA at 18 or 21? I think you keep an UPMA as a Fidelity custodial account until 21. So just clarification around those two types of accounts and when the child becomes the
Yeah,
owner.
it's going to be the same for depending on what state you live in because it's 18 or age of majority for both of these. For Utma, definitely the TA 530A accounts. That is also age of majority for how they can do the Roth conversions and move it to, but in order to take money out of it, I think you can do that as soon as you turn 18, but you don't get full control until you turn the age of majority. It's like a kind of gradual process there. Um, so it is a little bit different, but once your child turns 18, I think we'll have more, or once children that have opened these start turning 18, and I think we'll have more clarity on how the whole process is going to work. It's still kind of too early in the cycle because they're only, a month old right now.
Got it. That's all the questions you covered the answers to the other ones in your presentation. So I'll sit there.
All right, well, it's we'll show you one more slide here. We have a couple examples of how these accounts can grow. Example one is basically you just take the $1,000 seed money and you assume it grows at 7% for 18 years. That turns into 380, and then like for another 41 and a half years, it grows at 7% still. It's $56,000 at age 59 and a half. That's not a nothing. In 59 years, it might seem like nothing, but because of inflation and whatnot, but it's still not nothing. But if you put some money into these, if you max fund the $5,000 annual contributions for 18 years, then you start getting into $3 million at 7%. And if you put 8%, 9%, 10%, the number can get really big. So there is a planning opportunity here. But again, you have to you have to achieve those other goals first before you start talking about your child's own retirement. All right, well, that's it. Thank you for joining us today. As Garrett said, this is being recorded and we'll be posting it on our website for anyone that missed it today to see. If you do have any questions, please feel free to reach out to your advisor, and especially if you're interested in setting one of these TAs up for one of your own beneficiaries. Thank you for joining us and have a great rest of the day.